Hi, it's Professor Mike, and today we're talking about Chapter 10, Assessing and Responding to Fraud Risk. Now, one thing to keep in mind as we're evaluating fraud risk is when we're doing an audit, we're looking for material fraud. Unless you've been engaged specifically on a fraud audit, you are not looking for immaterial fraud. If we do uncover immaterial fraud, we have an obligation to report it to management and the board of directors of the client and potentially to law enforcement, depending on the facts and circumstances and our obligations as to where we find the fraud. But immaterial fraud is not the focus of what we're trying to do here. So let's talk about fraud. Fraud's intentional misstatement of the financial statement. So when you think about our audit risk, our audit risk is really defined in two areas. One is that there's intentional misstatement, which is fraud, and mistakes or errors, which are not fraud. So it depends on intent in this case. Either one of these errors, if material, is requires us to either modify our audit opinion or request the client to make a financial statement adjustment to correct the error or the fraud. Um, the two main categories of fraud are fraudulent financial reporting and then misappropriation of assets. We'll talk about each of these individually. So, fraudulent financial reporting is where you intentionally misstate or omit items or amounts that should be reflected in the financial statements with the specific intent to deceive the users of the financial statement. So you're in the case of something like Enron, you were keeping um, you were keeping entities off the books so that the financial statement user didn't know about all these obligations or the fact that you were recording income from phantom shell companies or selling worthless assets to phantom shell companies and recognizing gains. That's intentional misstatement or omission. Misappropriation of assets is actually taking stuff of the entity's assets, right? And that's usually happens at lower levels of the organization. Ironically, many types of misappropriation of assets actually happen in not-for-profits where controls are not strong and where there's a high degree of trust. So if you think about, the Catholic Church has had real problems with either priests or lay people stealing their collections because it's mostly cash and they're not subject to strong internal controls in a lot of cases. And it's an area where you have a lot of trust. So you will see fraud in a number of different places. But again, for us to worry about it from a financial statement standpoint, it's got to be material. Okay, so conditions for fraud really come from common sense, right? There's incentives or pressures, there's opportunity, and then there's the rationalization that what we're doing is actually right. So incentives or pressures are where management or the board or external factors cause us to want to misstate the financial statements in most cases. So um, in the case of misappropriation of assets, it's you don't have money, and you need money, or you need to cover a gambling debt or alcohol problem or drug problem or something like that, right? Those are circumstances where you might have incentives or pressures. In the case of financial statement reporting, it's usually because the financials are not hitting whatever targets you've promised or management has promised, or you're not keeping up with your competitors. And so that creates specific circumstances where there are incentives or pressures to commit fraud. The the you know Most of the time it's situations where you want to be ahead of your competitors or you want to be in line with your competitors and you simply aren't. So, personal financial gain, this goes to a lot of stock incentives. that are granted particularly with technology companies. Point of this class is to talk about specifically software companies and technology companies, most of which incent their executives with equity. That equity becomes worth more as the stock price rises, and the things that drive stock prices up are consistent performance, usually consistent performance above competitors. That's what's going to keep your stock price up. You want predictability and you want reliability in earnings. And there have been a lot of cases where companies have faked it in order to create that reliability and that predictability. Fraud can also be holding reserves in place, right? You can stash away reserves. They called them cookie jar reserves. Walter Schutz, former chief accountant of the SEC, former KPMG partner, had a famous speech in 1999 or 2000, which you can look up on the web, when he was SEC chief accountant, talking about the use of cookie jar reserves to help earnings when earnings were soft, and put away money where you were significantly exceeding what had been communicated to primarily Wall Street. But that can also be private investors as well, right? So personal gain and greed are by far the places where you're going to have the most risk of fraud. And opportunity is usually where there's weak internal controls. Again, like we said, charitable organizations have weak internal controls. Therefore, they're more susceptible to fraud. But any place that has a weak internal control or just has the wrong tone can be susceptible to fraud. Here's some age statistics. Men are far more likely to commit fraud than women, and the time with the company actually doesn't play as big a role. In fact, long-time employees are more likely to commit fraud than anybody else. And then, it doesn't, the level of the person in the organization is kind of across the board. So, the risk factors for misappropriation are, again, individual incentives, personal financial obligations, things like that. So how do we assess the risk of fraud? We are required as an auditor to assess the risk of fraud. And so we consider a broad set of information. And ultimately, you have to have some skepticism, professional skepticism, and you have to look at the audit evidence. If it's too good to be true, it probably is. So how do we look for fraud, and how do we comply with the audit standard? Well, there's really several different things. One is communications among the audit team. There's often not enough communication between the partner and the lower level staff, who are the ones who might be on the ground and might first uncover something that might be suspicious, but never raise it to anybody's attention because they don't know any better, or they're feeling rushed to finish their particular task and feel like whatever explanation the client gave them is fine, right? We do inquire of management. The inquiry of management and making them step up and say, hey, I'm not aware of any fraud, is actually effective. Then looking at individual risk factors, including competitive pressures, Wall Street pressures, the overall market, things like that, as well as where the company is in its life cycle, how are its products doing? Are they having excessive returns? Are they kind of behind the curve on product development, things like that? Analytical procedures, if you look at Crazy Eddie and some of these other things that are cited in the text, a strong analytical review should have uncovered some of this information. And then a lot of external information also helps. A lot of analysts and short sellers do have legitimate questions about company performance. And you should take a look at those. You should be skeptical of those as well, because those people have incentives to drive the stock price down. You don't want to take their word as gospel, nor do you want to take the client's word as gospel. To quote a famous president, trust but verify. So when you have material misstatement due to fraud, you evaluate all sources of the information to assess whether there is material misstatement due to fraud as part of audit planning. And then the assessment of fraud risk, just because it was planned and maybe you said, hey, we don't have a high level of fraud risk in this account, you still should reassess based on the findings of facts that you have during an audit. If you start to see pressure, if you start to see a series of individual events that ultimately add up to bigger events or a change in tone with the client, then you have to be concerned that there may be fraud. So you look at a bunch of different information as illustrated here, but really corporate governance oversight is the key to reducing fraud. Management is responsible to ensure that there isn't fraud, and some of this is prevention, some of it's deterrence, some of it's detection. Detection happens after the fact, or can be immediately correcting. But prevention and deterrence are the two biggest things you want to see from a client standpoint, because then fraud doesn't happen, right? So the auditors look for the guidance from the AICPA, which it basically says the things about tone at the top, right? Culture of honesty and high ethics. Management evaluates fraud, and then there's audit committee oversight. So the fraud risk assessment should happen by management as well, right? How risky is their organization? What kind of tone do they set? And they should have a fraud risk management program, which it allows people to certify that they have not been aware of any fraudulent transactions, any violation of Foreign Corrupt Practices Act, anything like that, on a routine basis. As a senior level finance executive in public companies, I've signed those risk assessments many times. And it is something that when you're signing something, you are thinking about it. And so there is some teeth behind these things, and there is the thought process and the evidence that says that when you sign one of these things, you actually do take it seriously. The other thing is when you find an issue, you want to make sure that you take corrective action and you investigate. And that there's monitoring activities. So, for example, little things, right? Little things make a huge impact. When somebody submits a bogus expense report and tries to submit something that clearly is a violation of company policy. I had one person who, who had a 30% tip reflected on the receipt that he submitted to me for an expense report. He made the poor decision of also submitting his American Express bill. He had blacked out all of the line items on the American Express bill so that he thought that I could not see those. But just simply holding them up to my overhead light and comparing the charge to the charge on the credit card bill led me to find that the employee had in fact inflated the amount that he wrote on the receipt that he submitted for the expense report, but the actual credit card charge was significantly lower. By making sure that that employee was dealt with appropriately, and also making sure that that was broadcast throughout the organization that it was found, that tone established the fact that we weren't going to tolerate anything that represented any misrepresentation, even if it was for amounts like $20 or $30, which it was in this case. So the tone was established early and crisply. The CFO of Cisco used to hold up an expense report at a company meeting every quarter and make an example, not specifically naming the employee, but make an example of the submission by saying, hey, can you believe that this person tried to do this on their expense report? That's setting a strong tone at the top. So, the responsibility for mitigating fraud risk, it starts at the very, very top, which is the board and the audit committee. There may be a separate corporate governance committee as well. So those folks, plus leveraging the internal audit team for public companies, but also leveraging the relationship with the external audit team, us as third-party auditors, really helps establish a strong foundation for finding and reporting fraud. So then management ultimately has primary responsibility for preventing fraud, both in financial statement reporting and in misappropriation of assets. So how do we respond to the risk of fraud? We've got to have, as with any element of our approach to auditing, we've got to look at the top level responses. We've got to look at fraud at the individual assertion level. Remember, completeness, existence, accuracy, valuation, ownership, presentation. And then a lot of fraud can be perpetrated, and in some of the cases you've done, is perpetrated by people with multiple people within an organization and management overriding internal controls. So the auditor's assessment, as we said, should be ongoing throughout the engagement. They should not just stop at the planning phase and say, okay, we felt like we had a low risk of fraud. We should continue the audit, even though we found a few things that might be a little suspicious. Conversely, if we went in having a high risk of fraud and things are clean, we should appropriately adjust our audit procedures as opposed to trying to, essentially conduct a fraud audit. But if the accounting records are messy, or there are discrepancies, or there are significant adjustments at the end of the period, I always would take the last 20 to 30 journal entries, especially if they were journal entries, and take a look at them for an audit period, because the last entry should always be tax, the entry before that should always be bonus, and then the things that are before that are the ones that you really want to look at, where they might be making adjustments to basically hit their earnings target. And if you don't believe me, a lot of companies actually monitor whether they're going to hit their earnings per share target by rounding up or rounding down. So they may make adjustments to just barely exceed their earnings target by a few pennies, and they might do it at 0.500001 cents. Or half of 1 cent, so that they can round up. That's where you can kind of see that things may be being manipulated. So those are kind of things to watch out for. The the other thing, we've talked a lot about independence, and this is where you can get into trouble, right? I mean, time and time again in the cases we've covered, the auditors have not been independent and objective. And the auditors in the case of Enron, who questioned Enron's accounting or were suspicious, were pushed away from the engagement. Um, the other thing is, if your analytical reviews later on in the engagement find something that still looks suspicious, you should uh, follow up. Finally, if your inquiries to management, their responses are vague or don't seem plausible or are inconsistent, that's where you have fraud considerations. Um, the major areas of fraud, and we're going to talk about this in the revenue recognition um, area, but revenue recognition is by far the biggest source of fraud. Whether it's fictitious revenues, premature revenue recognition, adjustments to reserves, you name it. There's a ton of things in revenue recognition that make it an especially challenging area, and that's why the books that are on revenue recognition are 1,000 pages long. Um, in Analytical procedures help you with revenue recognition. Just hardcore reviewing documentation is one of the best ways to uncover revenue recognition issues, as is following up on collections, talking to customers, things like that, and what kind of controls the companies have. Little things that are unrelated to financials, like understanding the product development process for software, understanding bug reports, understanding customer service tickets, understanding returns and warranty obligations, monitoring social media channels to see if people are continuously complaining about the product, and a lack of response from your client on refunds. All those things can lead to challenges with revenue recognition or product return reserves, which also affect revenue. Um, the other things that could be done are you don't record a sale, right? That's a way to misappropriate cash. Nowadays, that's less likely. Again, from a material fraud standpoint, obviously, if a sale never gets recorded and you're able to take cash, then you're going to have an inventory problem. But if it's a service, then it could completely be done under the table without you knowing. But again, that's probably not going to be material fraud. The inventory fraud risk, again, like revenue recognition, inventory is an area where people can manipulate. They can say that goods are good without them being good. Bad semiconductors out of warranty, or returned items restocked as good, things like that. And also, there's misappropriation possibly because it can be readily available for sale. eBay and Craigslist have created an easy marketplace for stolen goods. And if you want to think about something from an internal control standpoint to prevent fraud, think about how your experience is at Costco when you buy an item that's got some value or is small, like computer hard drive. We recently purchased Wi-Fi, Google Wi-Fi setup for our home. Had to go to the Costco cage. So there's a segregation of duties, right? The item is not on the shelves, so it can't be shoplifted from Costco right away. The cashier is the person who actually records the sale and takes your credit card, but they're not the ones who hand you the goods. You've got to take that receipt and go over to the cage and exchange the little card that you picked up in the aisle with the receipt for the item. And then again, as you walk out of the store, they check the item against the receipt. So there's a number of different processes within a Costco that you encounter in everyday life that are internal controls for fraud. Purchases and accounts payable fraud risk. Usually in this area, there's a lot of kickbacks and things like that. That's using preferred vendors so you can get a discount, you can get free concert tickets, you can get free airline tickets, things like that. That's where you've got to actually watch out for procurement people who establish relationships with vendors and don't want to walk away from those vendors. IT people and procurement people are big challenges in this area. So what do you do when you find a fraud? You first determine the source of the fraud and whether it's credible. Usually there's anonymous tips. An employee will give you information because they know that something's wrong, but you've got to keep it anonymous. And internal audit can find some stuff. And also, people screw up when they commit fraud. So you could find it completely by accident. You make additional inquiries, but you have to be careful making the additional inquiries. You don't know who to trust at that point. There's a number of different ways you can do it. The interrogative inquiry is the most combative. That should usually be done by somebody who's very senior on the engagement team or someone outside the engagement team. When you get to the point where you're doing interrogatives, this is often accusatory, and you have enough information to really establish that there has been a fraud, and now you're trying to figure out who's actually responsible. You have to figure out whether material fraud has occurred in addition to inquiry, data analytics, and other substantial tips and internal audit, and even management uncover fraud quite significantly. This is very important because it is one of the auditing standards that we establish procedures. We plan to detect fraud. So you're supposed to document the consideration of fraud in your audit planning and in your audit process. So what did you do, and what did you conclude? And then you've got to consider the risk of material misstatement due to fraud. So the analytical procedures that you did and any other auditing procedures that you did, and what did you find and how did you respond, right? And then also make a communication to the audit committee, to management, or to the board of directors that outlines the consideration of fraud that you had in the financial statement audit and whether you uncovered any instances. You need to affirmatively state if you did not uncover any instances of material fraud. You need to so state to the audit committee and the board of directors in a clear communication. Okay? Now on to Chapter 11.